Well, good afternoon, Excellencies, distinguished speakers, and dear guests. My name is Hamza Ali Malik. I'm the Director of Macroeconomic Policy and Financing for Development Division, UN ESCAP. I'll be moderating today's event on Rethinking Public Debt Policies for the Sustainable Development Goals, Regional Perspectives. This is a joint effort of all 5 regional economic commissions of the UN, and I'm very grateful to all my colleagues for their collaboration and for making this happen. We have also produced a joint policy brief as a background document to this particular event. It's titled as Addressing Public Debt Challenges for Sustainable Development Goals. You can find the entire paper on the events webpage. Let me briefly explain the structure of the event. So to kick off discussions, I'll start by asking a question to each speaker. And given time constraints, we have overall 1 hour for the entire event. I'll request them, kindly please keep your initial responses to around 5 minutes or so. And we will then open the floor for questions. We have already received several questions in the online registration for this event, about 14 of them. So I might take some of the questions from there. And then towards the end, and if time permitting, I will come back to each speaker for their final thoughts. So let's start the event itself. Let me start with our first speaker. So I'm very honored, actually, to have His Excellency Mr. Shihan Simasinghe, Minister of State for Finance, Government of Sri Lanka. Excellency, Sri Lanka is going through its worst economic and sovereign debt crisis. Restoring fiscal stability and public debt sustainability while mitigating the impact of the crisis on people is one of the immediate priorities of the government. Excellency, could you please share with us some key policy lessons that other developing countries experiencing elevated debt distress can learn from Sri Lanka's experience? How can the international community, including official and private creditors, multilateral development banks, and credit rating agencies, better support Sri Lanka under the current difficult situation? The floor is yours, sir.
Thank you, Hamza. Excellencies, distinguished participants, let me thank all the 5 regional commissions for organizing this event and giving us the opportunity to exchange views on the topic which is at the heart of the challenge developing countries face in realizing Agenda 2030. It is public debt and its impact on achieving the SDGs. Sri Lanka, a developing country, had provided a model to the world in the achievement of high levels of human development despite the constraints of a typical developing economy. At its core has been a free education and a free healthcare system for all citizens, enabling the achievement of a number of SDG targets such as maternal mortality of 12 per 1,000 live births, life expectancy of 72 years, and a literacy rate of over 90%, to name few. However, in the recent times, Sri Lanka was also confronted with the polycrisis, a combination of related global risks with compounding effects, with the overall impact exceeding the effect of each part. This phenomenon has burdened many developing economies, causing it to struggle with unsustainable levels of public debt, and in Sri Lanka's case, experience a state of financial hemorrhage. As a result of the impact of this crisis, most of our foreign currency financed public investment projects have faced a state of frustration. These include projects to provide potable drinking water as contemplated in SDG 6, projects in rural-urban connectivity to facilitate the rural entrepreneurs, in particular farmers, to be better connected to markets as in SDG 9, projects in facilitating improved electricity distribution linked to, again, both SDG 9 and 7, to name a few. It therefore inevitable that the country's journey to achieving SDGs must suffer a significant setback. We are also aware that until after the debt restructuring process is concluded, that funds previously allocated to these projects by our creditors will not be available for disbursement. Time is therefore of the essence. 12 months have lapsed since. It must be appreciated it would be entailed a few more months of negotiation that the debt restructuring program is concluded and the foreign currency financing from the original creditors will begin to flow. You will also appreciate that there is inadequate fiscal space to provide the required bridging finance to facilitate these projects to continue without any interruption or impediment until an effective resolution to the debt restructuring is reached. Predictably, in the interim, contracting parties have terminated their works and have proceeded to resort formal proceedings to pursue their causes of action. We cannot ignore and also face a necessary concomitant of being placed in a situation of financial inadequacy when after more than 12 months or more months of stoppage of work. The project costs have increased due to the cost escalations of raw materials and other connected inputs, including the cost of electricity. The recently launched Economic and Social Survey of Asia and the Pacific 2023 by the ESCAP clearly notes that high debt levels are necessarily detrimental to economic growth and has been challenged in the years. On the other hand, development deficits and climate risks, if left unaddressed, will have serious implications for growth and the sustainability of public finance. It would therefore appear that there is a rationale for the reconsideration of the assessment of sovereign's ability to repay and service loans vis-a-vis its differentiated competencies. It is time to look beyond GDP. It must be stated that multilateral partners have a key role to play in the context if we are to build back better, leaving no one behind. It is interesting that this essence of our point is discussed in the Economic and Social Survey of Asia and the Pacific 2023 by the ESCAP, where I quote, chronic fiscal austerity, especially in countries where sizable sustainable development gaps remain, would inevitably jeopardize their ability to finance much needed investment in poverty reduction, human development, and actions, unquote. We are confident that the growing green and the blue financing market could be an answer to the dilemma faced by sovereigns that are faced with investment gaps due to fiscal constraints and external sector weaknesses. However, currently the green and blue financing, apart from providing targeted funds for green and blue complement projects, seems to be following the same process and agreements which includes the collective action clauses similar to the plain vanilla bonds, which has no intrinsic options or structured element that offer comfort space for parties in debt distress. We appreciate that financial facilities require some form of collateral, but it is also possible to provide same sense of security through multilateral partners through the provision of sufficient de-risking support. Sri Lanka is experiencing the full brunt of the impact of financial distress, fiscal consolidation, and low negative growth. Our people have been subject to financial stress by the Easter bombing crisis, followed by the COVID pandemic, and then by the conflict in Ukraine and the effects of climate change, and continue to experience hardship until recently, when we present government adopted compelling fiscal and other measures of good governance to offer its people a respite from difficult times they faced in the last 3 years. Yet it is resilient because it has an asset base, both natural and otherwise, that support it to sustain itself better. It has an informal economy that is well connected and resilient. We are confident that the resilience of our people will ultimately enable us to overcome the current challenges. The government is committed to take necessary domestic policy decisions on matters such as restructuring of state-owned enterprises, measures to eliminate corruption, to introduce digitization of government procedures, thus enabling the public to better access to government services and reinvigorate institutions to boost investment and foreign trade and to convert to a private sector-driven economy. It is therefore my plea to you excellencies, representatives, that it is time we change our perspective on public debt and its policies so as to enable countries to overcome current challenges, foster economies that actually support the creation of wealth and sustainable development in a spirit of true multilateralism, to form a collaboration with the objective of providing developing nations such as Sri Lanka to address the challenges of the people of the world on the basis of inclusion, solidarity, and consultation. Thank you.
Thank you, His Excellency, for sharing Sri Lanka's experiences and highlighting the main thrust of this event today, how to reconcile the actual ground reality of constrained fiscal space and at the same time trying to pursue sustainable development ambitions and climate action. We will hopefully have more discussions around this issue. So building the conversation further, let me now invite our next distinguished speaker, Mr. Pedro Manuel Moreno, the Deputy Secretary General of UNCTAD. Mr. Moreno, as you know, risks to debt distress are rising across the globe. In your experience, your understanding, what are some key immediate and medium-term policy actions, both at the national level and by international development community, that are needed to avoid a systemic debt crisis? In this vein, as you know, the UNCTAD Secretary General has recently noted in her op-ed that the world urgently needs an independent sovereign debt authority that serves the interests of both creditors and debtors. Among other functions, such an authority can provide coherent guidelines for suspending debt payments during shocks and other advice to governments in need. What needs to be done to make this happen? What is the role of the United Nations system in this regard? The floor is yours, sir.
Thank you, moderator. Your Excellencies, ladies and gentlemen, our world has been embattled by a series of crises, from the COVID-19 pandemic, the war in Ukraine, the climate crisis, to a cost of living crisis, and all this in a daunting global macroeconomic environment. Facing these challenges has required enormous resources, forcing many countries to increase debts and the heavy burden that comes with it. Debt distress today is a major obstacle to sustainable development. As access to liquidity becomes more limited and fiscal space shrinks, the growing debt is an extra burden to carry on an already bumpy road to achieve the sustainable development goals. We are not yet in a full-blown debt crisis, but we are already in a development crisis. The problem is that the existing approaches to debt sustainability prioritize debt repayment over development spending. Over the last decade, the number of countries spending more resources on external public debt service than on healthcare increased from 34 to 62. The debt service bill of the least developed countries increased by 50% in a single year. They are paying 20% of their export revenues to service their debt and 16% of their government revenues to service their external public debt. Another problem is that most international efforts to deal with this issue, including the G20 Common Framework and the IMF Sovereign Debt Roundtable, do not cover middle-income countries. These countries, which house the majority of the world's poor, lack adequate access to multilateral financing, yet are also heavily constrained by debt. Despite the severity of the situation, the multilateral response to the development crisis has been and remains too little, too late. The current international financial architecture does not have the tools to provide immediate liquidity needed in moments of external shocks, like the ones we have recently lived. neither does it address unsustainable debt burden swiftly, orderly, fairly, and comprehensively. That is why the international community needs to step up its efforts to reform the sovereign debt architecture in line with the Addis Ababa Action Agenda. But immediate action is also needed. Otherwise, the growing risk of a systemic debt crisis would only aggravate the current development crisis. We, in UNCTAD, and following your question, moderator, propose the following immediate and medium-term actions. In terms of immediate actions, priority should be putting forward an improved multilateral debt relief solution, especially before large debt servicing payments come due in 2023 and 2024. The fastest and easiest way to achieve this is to address the shortcomings of the G20 Common Framework. An expert panel independent review could be conducted to propose improvements to the framework as called for by the UN SDG stimulus package. Improvements should include greater predictability and reduced action delays, provision of debt service suspension during negotiations, extension of eligibility to middle-income countries, and concrete tools to incentivize or enforce private creditors to participate in official debt restructurings. A new allocation of special drawing rights, the so-called SDRs, of at least USD 650 billion is needed. As of December 2022, 32 low-income and lower middle-income countries had already used half or more of their accumulated SDR allocation. IMF borrowing costs have increased from 1 to 4.5% over the last 15 months only. When including surcharges, the cost increases to 7.5%. These surcharges should be suspended to lower the burden. Also, lending from multilateral development banks, MDBs, and regional development banks should be scaled up massively. MDBs in total are disbursing about $100 billion a year, a fraction of what is needed to close the sustainable development investment gap in the Global South, which UNCTAD estimates at over $4 trillion annually. The UN SDG stimulus, of which UNCTAD is part, is calling for a tenfold increase of MDB lending to reach $1 trillion by 2030. We need to realize the so-called moving from billions to trillions. Developed countries should use their shareholder power to increase capitalization of these banks, while MDBs themselves should look for ways to optimize their balance sheet as proposed by the G20 independent review of MDB capital adequacy frameworks. A good way to innovate in this area is to channel SDRs through MDBs, a road that the African Development Bank has now opened for all to follow, and which we must all support. Then, in terms of reforming the international financial architecture, a core aspect is the provision of a multilateral debt workout mechanism, as already mentioned. Then, access of developing countries to the global financial safety net, as international liquidity must be improved. It should be a global public good. The safety net is deeply unequal, as low-income countries and most middle-income countries are excluded from almost all its instruments except IMF lending. Also, debt sustainability assessments should be designed in a way that incorporate development and climate financing needs. And finally, a public debt registry for developing countries should be established to enhance transparency. Ladies and gentlemen, balancing the post-pandemic recovery, the pursuit of the SDGs, and debt sustainability is crucial. There is an urgent need to assess the current state of public debt around the world, its impact on development, and explore potential policy options. The United Nations Global Crisis Response Group and the UN Regional Economic Commissions are currently working on this. The project aims to monitor the ongoing debt situation through a standardized set of indicators compiled into a comprehensive database. This will provide policymakers and stakeholders with a better understanding of the impact of rising public debt on development, allowing for the UN to identify existing policy options to address this issue. I can assure you that we are working relentlessly on this as much is at stake. I thank you for your attention.
Thank you, Mr. Morano, for a very comprehensive list of potential solutions that can be pursued. And I couldn't agree more with you with this remark. We're already in a development crisis, if not a full-blown debt crisis, and there are several weaknesses you highlighted, including the ones related to the G20's common framework. Picking on this particular point, let me now invite my next speaker, Ms. Hanan Morsi, who is the Deputy Executive Secretary of Economic Commission for Africa. Ms. Morsi, G20's common framework for debt treatment has been ineffective by and large so far, as the previous speaker also alluded to, in delivering an efficient and timely debt resolution mechanism. What reforms to the global debt architecture the ECA coordinated Africa High-Level Working Group on Global Financial Architecture is advocating for? I would like to hear your views on that, please. The floor is yours, ma'am.
Thank you. Good afternoon, everyone. Let me just perhaps start by giving an overview of the Africa High-Level Working Group, which is a group that the Economic Commission for Africa serves as secretariat for, and it's composed of African ministers of finance, planning and economic development, as well as key African stakeholders, African Union, African Development Bank, Afrexim Bank, and IMF and World Bank. And this group started February of last year and have been meeting regularly to discuss issues related to reforms that are much needed in the global financial architecture to make it work better for Africa and developing countries. Within the common framework, the G20 Common Framework was introduced as a way to basically provide a platform for debt restructuring that includes beyond the Paris Club creditors, that includes other creditors. However, as we have discussed with the ministers of finance and has been endorsed by them, there's a need to overhaul the G20 Common Framework to make it more effective, transparent, time-bound, to expand its eligibility to middle-income countries, and to have a suspension of debt service upon application to the framework. So these are really important reforms that need to happen to the G20 Common Framework. Out of the 4 African countries that applied to the framework, 3 years later, we have only one that reached some sort of tentative conclusion, which is Chad. So we need a system that works more effectively and efficiently. We need also to have expand the committees to include private sector. We need to establish a comparability of treatment formula that reduces the issue of technical disputes and speed up the process. And in addition to the reforms in of the G20 Common Framework, we need to see bolder use of IMF lending into arrears to reduce holdouts of the holdout of creditors. And beyond these things, we also need to see reforms at the legal and regulatory system. We need to actually have international jurisdictions that have the bond issuances start to require the inclusion in new issuances of collective action clauses and force majeure clauses that also include climate and pandemic and other force majeure events. So these would be really critical. We will also need to see implementation of anti-vulture legislation, legislation. So there are a number of issues that are needed. Some are in the design of the G20 Common Framework, some in terms of other instruments like the lending into arrears that can help. But then we need also at the legal framework things that can make it really much better going forward to avoid the type of things that we see now that slows down the process. There are also, of course, a number of other issues that has been discussed in the group, and I think very much in line with my colleague from UNICDAT that have highlighted, among which has been the issues that there is a need to suspend and waive surcharges that affect a number of middle-income countries. Currently, 6 African countries are actually affected by these surcharges. So that need to be waived or suspended for a few years. There's also the need, given the current state of affairs with the high and rapidly accumulating debt level and the very difficult global financial situation, to actually ensure availability of concessional financing. And in this regard, 2 elements are very important. One is the sustainability and funding of the PRGT resources, the Poverty Reduction Trust Fund at the IMF. Currently, the subsidy account of that fund has not been fully funded. It still has $1.2 billion of a gap. And sustainability of that fund is key to ensure availability of concessional financing that would be much needed by low-income countries. Same thing at the World Bank for the IDA resources and the fact that we will have IDA cliff going forward with a decline of $10 billion. We need to make sure that these are actually, these additional, very important additional resources are secured to maintain IDA, but also to scale up IDA. Because going forward, concessional financing will be key to low-income countries and even middle-income countries that are vulnerable. So availing these resources, a lot of efforts should be put forward to ensure that. And in general, we need to see better lending terms, for low and middle-income countries to meet SDG investment needs and climate action. So we need to see cheaper financing, lower interest rates, longer maturities, allowing for state contingent repayments. These are the type of reforms that we need to see going forward. There were also other things that the group have highlighted related to the special drawing rights. And here, in addition to fixing the system and how it's allocated in terms of making it more evidence-based and analytical, we need also to enhance the rechanneling. And I believe, as had been echoed as well before, the issue of endorsing and supporting the proposal that was put forward by the African Development Bank and Inter-American Development Bank for rechanneling special drawing rights through MDBs would be a very good way to actually, facilitate the rechanneling and also achieve 3 to 4 times leverage. And what is needed in this is to have basically 5 countries to support that. So, having the political will and the, advocacy of everyone will be key to get this going to avail resources. There are a lot more that we can discuss, but I'll stop here.
Thank you very much, Ms. Morsi, for very clearly linking the work you're doing in Africa with the global reform of the financial architecture, especially related to debt. Whole list of issues that are being addressed, needs to be addressed, including the use of PRG trust fund that is still not being utilized to its capacity, rechanneling of SDRs, importance of concessional financing, and so on and so forth. Let me try and take a slightly different angle now. I invite my next speaker here, Ms. Elisa Parisi-Capone. She is the Vice President and Sovereign Risk Group of Moody's Investor Services. Ms. Parisi-Capone, as you know, many developing countries did not participate in the G20-led debt service suspension initiative during 2020 and 2021. Among other reasons, they feared that such participation would be seen as a sign of upcoming debt default that may trigger a credit rating downgrade. What is your view on this? How can credit rating agencies help developing countries achieve both debt sustainability and sustainable development ambitions? The floor is yours now.
Thank you very much, Hamza, for the question. It's an honor to be here. I think it's important to define what a rating speaks to, first of all. An issuer rating speaks to private debt holders. If existing private bondholders receive less than face value and not on time, then that could constitute a default under our definition. So issuer ratings do not speak to official sector debt. That means that the same treatment would likely not have the same rating implication if applied to private sector creditors or official sector creditors. So it could indeed, if there is a treatment of official sector debt, it could indeed provide liquidity or solvency relief for private creditors, but it could also indicate mounting liquidity and solvency issues down the line. Specifically to your question about the DSSI issue, the participation, the lack of clarity on the potential private sector participation in the DSSI initiative really increased the probability of default for private investors, and that was reflected in our ratings. Similarly, when it was clear that private sector participation was not required to participate in DSSI, that was also reflected in the rating. Specifically, if we look at the documentation of the DSSI, it was clear the IMF, the G20 was very explicit that they would like to see private sector participation in DSI at similar terms. To be clear, if that was the case, it would constitute a default under our definition. So that is just for clarity of definition, what a rating speaks to. Now, specifically also to your question, the role of rating agencies in general, the rating agencies do not give advice. The ratings are intended to address agency problems and bridge information gaps between issuers and private sector investors. It is important also to highlight that credit vulnerabilities, they build up earlier. They build up during the good times. So by the time that the pandemic broke out, it was not that it was the trigger of the crisis, but vulnerabilities have been building up earlier. That is why it is important to constantly monitor credit risk as it builds up. For instance, we have seen in low-income countries debt to GDP increase to similar levels as the global median. However, if we look at debt affordability, if we look at interest to revenue, we have seen low-income countries, in particular also in Africa, deteriorating much more. And that has also to do with the shift in the debt structure. So this is just to keep in mind the role of credit monitoring. It is an ongoing process, and it starts much earlier than when a crisis breaks out.
Thank you, Ms. Parisi-Capone, for explaining exactly what the role of credit rating agencies is and who they're targeted at, and adding a little bit of clarity on why or concerns regarding DSSI. I'm not sure I fully agree with the observation the credit rating directly speaks to only private creditors and not sovereigns, because the rating agencies, once the ratings are given and revised or changed, it has a bearing on the credit sovereign risk as well. Maybe we can come back to this point towards the end again, and you can elaborate further. Let me continue with the next speaker here. I'm very pleased to invite my colleague, Ms. Sherry Spiegel, the Chief of Policy Analysis and Development Branch at UNDESA. She's been leading a lot of work, a lot of issues that have been highlighted already by different speakers. But one particular thing that has not been explicitly highlighted here, I would like to ask Ms. Spiegel, to actually touch upon that. And that is this debt restructuring and too little too late. I think Mr. Moreno also referred to that earlier on. This phrase has been trending recently in economic discussions whenever we talk about rising debt distress across the globe. So kindly please share your perspectives on exactly what is being referred to when we hear the term too little too late. What should creditors do to act now and decisively to avoid essentially too little too late? How can engagement by unconventional creditors such as non-Paris Club creditors and private bond holders in debt restructuring processes be increased? Right? So what policy messages you and DESA is advocating in this regard?
Great, thank you so much, and a pleasure to be here with you. And, the issue of too little too late, actually, it's trending now. It trended before we had trending in the 2000s and late 90s when I was working on debt issues as well. The meaning has changed slightly in the current context because of thinking more about the SDGs. But so the first issue is let's start with too late. And I think there are two pieces to it. The main piece is calling debt too late. So when do you know that you're in a debt crisis? And when do you go to your creditors and say, we need to restructure debt? And the delay, and I think this is widely acknowledged now, is very costly. Because if you restructure sooner, then you're able to do it more efficiently. It's before it becomes a crisis, and you can avoid some of the costs that are the social costs that come along with the crisis when there's a delay. So I think that we know that there are a lot of reasons why this delay happens, and I'll get to that in a second, maybe for the second part of your question about how to avoid this. The other piece of too late, which is not about calling debt, but it's about how long it actually takes to restructure debt. So it's not really too late, but it's the issue that it's so slow to restructure, as we see what's happening now with the Common Framework, that some of these restructurings are taking, they're all taking over a year at least. But I do want to point out, because some people say, well, we've solved the problem with the private sector because we have collective action clauses, et cetera. But there as well, most restructurings take certainly over a year. I think the average is 2 years, but I might not have that number correct in my head. So it's not, in both cases, we have this countries resist calling, they don't go to their creditors. Creditors resist having to deal with restructuring until the last minute, and then the restructuring process takes a long time. And all of that has enormous social costs associated with it, both leading up to the crisis, and then when you have a crisis, delaying the restructuring process has social costs. The second piece of this is being too little. So there it's very clear that, and this was always an issue. So going back to the 2000s, we did studies looking at what we called serial restructurings, countries that would go restructure, and X years later they were back in another crisis. And the reason for this is obvious. The incentive structure of private, and I'm thinking for a second about the private creditors, and then we can talk about public creditors as well. But for the private creditors, commercial creditors, the incentive structure is such that they want to have the minimum haircut so that the country can start repaying its debt. But I should have maybe have said that that started with, when you think about a bankruptcy regime, two of the key premises of a bankruptcy regime are effective and efficient restructuring, that's the timeliness, as well as a clean slate. And a third one is equity issues across different creditor classes. But the issue of a clean slate, if you restructure under Chapter 11, for example, in the United States, when a corporation goes to and says that they're under bankruptcy and they go to restructure their debts, the idea is to give that corporation a clean slate to wipe down the debt so that they can then begin operating again. But in sovereign bankruptcy, partially we don't have a bankruptcy court, the incentives are to just give enough of a haircut so that the country can begin to repay its debt. But that doesn't mean that it has a clean slate to grow. Now that's bad, one, from just the pure economic side of it, because if you don't, the country is not, if they still have the debt burden and they're still paying high interest rates or a big interest burden, then they don't have that ability to begin to grow and then repay its debt, so that even as a creditor, if you were long-term enough, you wouldn't like that. But most creditors we know are short-term. And the second, of course, is from the thing that a country is not a corporation, they're people. And the issue is, that the impact on people's lives of not coming out from underneath that debt burden and having to continue to use services. Again, this question of no fiscal space and how do you invest and deal with your social services. And I think the SDGs have made this issue even bigger, because now we need to think in ways we hadn't before. They're the social issues. They're issues of, for example, social protection issues. And then there's this issue of how do countries invest in the future, and particularly, for example, invest in resilience. Because without being able to invest, these debt crises are going to continue to happen. If you can invest in resilience, you can at least possibly limit some of the impact of future crises, and also that will improve your debt sustainability as a side effect. And so the thinking about what the amount of debt relief has to be today really it always had to include social issues, and now I think it really has to include the SDGs, which just means a much bigger write-down. Now, to get markets to think that way is going to be very hard. For two reasons. One is because it's just not in their interest, but even if it were in their interest, if they were long-term thinking, because some markets don't think that long-term, then it's really not. So we're in a situation where debt restructurings are not efficient, they're not quick, they're not timely, and then for a whole host of reasons, they are not sufficiently deep enough. Now, for public sector creditors, they should, the issue of how deep the haircut goes should be something different, because they have a different set of incentives. But even there, especially now, with a lot of political pressures on public creditors, on the official creditors, it's very hard to imagine that there's enough incentives for official creditors also to give enough of a haircut. I mean, certainly HIPC, well, even HIPC wasn't enough. They went to MDRI. So after the HIPC agreement started, the next agreement that was agreed was the Multilateral Debt Relief Initiative that wrote debt down by 100%, once again realizing that it wasn't going to be sufficient, the amount that the debt was being reduced. So now we get to the second part of the question, which is the question of how do we address this? So actually, I think that when our colleague from Moody's was saying, what's the point of ratings? I think that the first issue is that ratings and debt sustainability analyses are certainly a really big part of this. And I think that came out in the earlier discussions today as well. So, but for that to be done, then what does the debt, because they are how they're imagining they're both in terms of calling a debt crisis when it happens, so dealing with the too late part, you need to have analysis. It's part of responsible lending to have really good analysis to understand what the credit is of the country you're lending to. And then it's also a question when we think about restructuring, how much restructuring is needed. So in that sense, and this particularly goes less to a credit rating, but more to the debt sustainability analyses, the importance of thinking about how does one begin to bring in some of these social goods and needs of investment into the DSA in terms of thinking about how much of a write-down is needed. But the question, the way that you phrased it, was a little bit, because the question was, what should creditors do to act now and decisively to avoid too little delayed? And I think that, unfortunately, it's not in creditors' interest to do so. So I don't see them doing that unless there's outside pressure. So, because again, they are incentivized, and I used to do this, for those of you who don't know, I used to invest in sovereign debt. So the incentive structure is such that you are paid by your fiduciary responsibility is to maximize returns to your shareholders, and you are paid annually, and your shareholders are also looking, I mean, later on it was pensioners, it was a little different story, but they're also thinking, they're looking and judging you against other fund managers on an annual basis as well. So everyone's thinking in a very short-term manner. So there's very little incentive to think about the long-term sustainability of a country and how do I help structure the debt to make it a long-term and sustainable. So I think the conclusion is really that the framework just doesn't work for this. If we want to get out of too little, too late, the current structure we have is just, that's not what it's doing. In fact, analytically, we used to call it a creditor-friendly, and we can get into that at a different time, a creditor-friendly bankruptcy regime, because we have a bankruptcy regime. It just doesn't work very well, and it's creditor-friendly in the sense that countries delay calling default because they're afraid of what happens when I default. There may be a crisis. It may be like what happened in Argentina. I don't want that crisis. So countries delay, creditors delay, and as a result, you have less defaults than you might have under a different world where countries felt like they wanted to restructure sooner. So in terms of what that framework would look like, I mean, we've heard a lot of proposals right now. I think anyone who's worked on sovereign debt issues forever comes to the conclusion you need some sort of to really have an effective workout mechanism, you need a mechanism. You need some sort of a bankruptcy court, just like we have with corporate bankruptcies. I don't know anyone who honestly believes once they leave the institutions they work in, they come back to saying, okay, the only effective way to really do this is to have a bankruptcy regime. And it particularly becomes obvious today when you have different types of creditors, because not so long ago we had middle-income countries that really only borrowed from the markets, most of their debt. The majority of their debt was the markets, and so they trying to address private sector debt with collective action clauses, et cetera, wasn't great, but at least it was muddling through, but with too little, too late. You had the other countries that were poorer, they were going to the Paris Club, they had very little market debt. Now we have a whole host of countries that have the structure of the borrowing has changed because of this cross business, because they have both market debt, official debt, and then these non-Paris Club creditors as well. And so now it really becomes important to think not only how do we settle debt in each of these groups, but how do we deal with this cross-creditor issue. And so, we don't have a solution for that right now. So a sovereign debt restructuring mechanism, some sort of a bankruptcy court would address that. But I think that we also know that that is politically been talking about this since I don't know when, since before I was talking about it. I started talking about it in the 90s, others probably, we know this was a discussion in the 80s. So it seems very unlikely for that to happen. So that doesn't mean that to all the CSOs in the room to not push for it, but I also think we need to think about second best options. And I think there's a lot of thinking going on as well about that. So, or steps to it. One of the interesting, important things that a bankruptcy court does as well, just to say, is that hopefully then you can actually have resolutions in the shadow of the law. Like if you had a clear idea of what a judge is going to do, that's going to make the restructurings that happen outside of the court. You don't actually go to the court. You have more and more restructurings happening outside of the court because we have the rules set up of what are the rules of the game. And so the question would be, are there ways to build that without having to build an actual court if the court is politically not feasible? So those are just some ideas to think about. I think we need to think first best, and we also need to think second best. Thanks.
Thank you, Ms. Spiegel. Very thorough and very realistic, actually. First of all, thanks for explaining this too little, too late in a lot of clarity. What exactly are the issues when we hear this term and when we talk about it, but more importantly, what can be done, what is politically feasible, what are the second best options, as you alluded, and what is unlikely to happen. So I like the candid responses. I think the UN system across the board, and represented here today by regional commissions, DESA, UNCTAD, are highlighting several possibilities, potential solutions that UN system as a whole is pushing forward. So I hope some of them will actually make it in terms of having a more coherent framework. I have one more speaker with me, last but not least, certainly. Let me invite Mr. Professor Ulrich Walz. He's a professor of economics at SOAS, University of London, and a senior research fellow, German Institute of Development and Sustainability. Professor Walz, you have been hearing about broader issues, reforms, and so on and so forth. Let me come to a little more specific question for you. What are the new policy instruments that are emerging for addressing the increasing debt distress and enhancing fiscal space for climate action and SDGs? That's a question we, in a way, started off with. How are the developing countries prepared to access such instruments and mechanisms? And what are the challenges do you see in developing countries to access these new instruments? The floor is yours, sir.
Thank you. Thank you, dear Hamza, and many thanks for the invitation to speak on this esteemed panel. Sorry, my voice is a little bit rough today. First, I think it's very important to highlight that there's now a widespread acknowledgement that there is a direct link between climate risks and impacts and public finances. So it is really important that we look at how we can climate-proof public finances, because otherwise countries are going to slide into what we've described as a vicious circle, where countries are facing a high cost of capital, and we've provided empirical evidence that the cost of capital are higher because of climate vulnerability. So this high cost of capital is constraining fiscal space. Countries have no room to invest in climate resilience and so on. And with climate change getting worse and also capital markets becoming ever more aware of the risk, there is this risk of countries sliding into the vicious circle. So we need to have a discussion on how we can have innovative instruments to break the vicious circle between climate risk and debt. But here we also have to distinguish between instruments for new debt and also for old debt. So for countries where already public finances are in a very difficult spot. And unfortunately, we have a lot of them right now. But on new debt, I think we need to see a much larger role on state contingent debt instruments. So certainly we are having now an important discussion about mainstreaming disaster risk clauses in sovereign debt instruments. I think that should be basically become the default option for all countries, including advanced countries, to really make this mainstream and not just kind of an odd clause for high-risk countries. We should also have a discussion about GDP-linked debt and so on, so to have instruments that provide fiscal space in times of economic trouble. But we certainly also need to have a discussion on old debt. And it was now mentioned already that we have a large number of countries, around 50, 60, that are already in debt distress or close to. And for these, we urgently need to reform the common framework, as Hanan Morsi has highlighted, to avoid the too little, too late problem that Shari explained so nicely. And if countries need debt restructuring, we need to make sure that this happens fairly quickly, and that we also need to make sure that this doesn't just provide a one-off relief, so not just some temporary relief, but that it helps to bring about broader reforms that help the country to adopt a more sustainable and climate-resilient development model. And with some colleagues, I have therefore put forward a quite ambitious initiative for debt relief for green and inclusive recovery, which is a bit of a modern-day version of HIPIC, which links debt relief with a green and inclusive recovery strategy, which debtor countries should develop themselves. And our proposal also involves some incentive mechanisms for private and commercial creditors to partake in debt restructuring using or building on the Brady restructuring of the 1980s and 90s. And as Shari mentioned, we do need to provide incentives for both debtors and creditors to come together. And one element which I think is quite important is also that we need to take the fear away from debtor countries that if they seek debt restructuring, that they will be in a doom loop for a number of years, but also that they won't have re-access to capital markets. And so one could think of tools for credit enhancement for countries that have went through successful debt restructuring and which then actually have a much stronger position and should be able to access capital markets again. But we also do need to support countries that have also high levels of debt, but they don't need a full-scale debt restructuring. So countries that need more fiscal space to invest in the SDGs and climate action, but that don't need a full debt restructuring. And here, UNESCO has developed what I think a very good proposal for a climate SDG debt swap donor nexus initiative to address exactly this problem. And so full disclosure, I've been involved in developing this, but I think the colleagues at ESCAP have done a great job because this is now not your grandmother's old debt swap, which were typically small in volume, fairly quite transaction heavy, with relatively little impact. And the ambition of this is to link debt swap, but kind of in larger scale, not just with small projects, but really a larger scale of projects with policy reforms that would really have transformational impact. And so this would basically involve a results-based wholesale program with KPIs, both at the project level and policy level, to accelerate reforms that will help more sustainable development and also more sustainable public financial management. And Hamza was already indicating that I should shut up, and I will do so, but just to say that this has been received quite well, and there are a number of countries that are interested in that, including Jordan, which is now seeking to pilot that. With this, let me conclude. Thank you.
Thank you, Professor Walls. I've been instructed by the organizers actually to try and wrap up quickly, and I still want to use the time here. I have 3 minutes more. I promise I'm going to finish. So several of the questions that we received online actually already been answered. I was looking at them. For example, what African countries need to do to get out of debt distress, how to reform international financial architecture reforms, they have been covered, how to engage middle-income countries that are facing debt distress, we've touched upon those issues, state contingent clauses, how to incorporate them, new instruments that Professor Wall was talking about. So a lot of issues that questions that were asked have already been covered. What I want to do now quickly is something interesting, take advantage of very distinguished panelists over here. So imagine you're going to leave with one message before we close the proceedings. I'll give you 30 seconds. Imagine that your statement is going to make tomorrow's headline in FT or some major global newspaper. What would be that fundamental message that you want to leave the audience with? 30 seconds, very precise, one main message on dealing with the debt distress, and what is your message? So let me start with the minister first. 30 seconds, sir. What will be your message?
Well, I think we have spoken about this. Early engagement is very much essential. I think that is something we also have learned out of the crisis as Sri Lankans. And then when you engage with all your creditors, comparability and transparency becomes the key. Definitely comparability and transparency becomes the key, and that is the success story of Sri Lanka.
Very clear. Early engagement, be transparent. Perfect. So let's continue in the spirit of key messages. DSG Moreno, what would you say?
If I would say 3 words, I would say multilateralism, multilateralism, multilateralism. I think most stakeholders agree on the diagnostic and differ more on the solutions. We have many mechanisms already that we have identified at different levels to make this less of a development crisis and avoid other mistakes of the past. And we just need to strengthen our efforts to be bolder and to be to try to get consensus as much as we can, but because the instruments are there.
Thank you, Mr. Moreno. Of course, we need to support, and we are all behind it, supporting multilateralism. Ms. Morsi, what would be your message, please?
I think we need to come together to really unify voices of debtor countries in terms of the needs and the urgency and what the debt come at the expense of, which is really climate action and SDG investments. So we need collective, we need unity in voice, and that's why platforms like Sustainable Debt Coalition that ECA is supporting is a good forum to bring debtor countries to think about these issues together, because that voice is critical in putting forward solutions and then calling for action from the debtor sides and finding the champions that can help push the agenda forward.
Thank you, Ms. Morsi. Coming together to increase the voices of debtor countries, very clear, to support SDGs and climate action. Ms. Perisi Capone, please.
Thank you. What I would point out is that a low income or a weak initial credit profile is not deterministic. There are plenty of examples of case studies of credits that have implemented reforms, that have improved their resiliency, and that have gone up in the rating scale. So reforms, work and governance is a key factor that is under the control of issuers.
Thank you, Ms. Perisi Capone, for an upbeat, optimistic message from your side. Ms. Spiegel.
Maybe I'll take a step back and follow along with what you said, but I think that multilateralism, but I think that every aspect of the multilateral system is now being questioned and looked at and re-examined, from tax issues to debt issues to how we think about reporting on and aligning finance, private finance with sustainability, to SDRs and the structure. So there are really, and they are happening in different fora. They're happening siloed, and there's a real importance to bring them all together, to do it in a cohesive fashion, to make sure they are all aligned with the SDGs and with climate action. And so this is really something, this is a bigger change happening now than probably any time since the 1940s, and it's up to us to see what that change is going to be and if that change is going to be effective or not.
Thank you, Sherry. Professor Walls, you have the last word.
So I think it's very important that we say clearly that we are now at a critical moment. We have a massive debt crisis looming in the global south. This was supposed to be the decade of action for achieving the SDGs, for making progress with the climate goals, and none of that will happen in a very large number of countries if we don't tackle the debt problem. So we need a very urgent reform of the common framework. We need to force all creditors to the table to provide swift debt relief. And importantly, we need to link that with the SDG and climate agenda because we won't be able to make any progress on that respect without tackling the debt crisis. Thank you.
Thank you, Professor Walls. I won't delay further. I'd just like to thank, on the behalf of all regional economic commissions, our distinguished panelists for setting aside time for joining us this conversation. A lot of specific points came out of that. We'll try and summarize them and share and post it on the event's webpage later on for follow-ups. And a lot of these ideas, I'm sure, will feed into various UN processes as highlighted, being led by UNCTAD, by DESA, by regional economic commissions, and we value the support we get from academia and rating agencies and other partners. So thank you very much once again, and hopefully we'll engage in other different capacities. Thank you, Minister Youssef.